Glyn, as we come towards the end of 2012, it's worth taking an opportunity to look back briefly and see what we experienced as investors, and then it's also a nice opportunity as we move into 2013 to look forward into the new year and assess the opportunities available for investors going forwards. So if we can start by looking at 2012, a mixed year really. From a headline point of view, what really went on?
Well, I mean, here we are 10 days before the year end, and there's no question that markets have done overall much better than people anticipated at the beginning of the year. The MSCI World Index Developed Equity Markets is up nearly 15%. Emerging markets up a little bit more than that. Credit has done exceptionally well. High yield has done well. But it's been a pretty rocky ride. We got to the middle of the year and markets were flat to down. And it's really only in the second half of the year that we've seen a surge in markets. But overall, this has been a good year for risk assets, unquestionably a good year, better than most people anticipated at the beginning of the year. We were positive about equities, although I think we'd have been very pleasantly surprised if somebody said to us we're going to get a 15% outturn, and that's pretty much what we've got. So it was definitely a good year for equities, a very good year for credit, and associated instruments, convertibles have done very well. So overall, markets have delivered some good returns, and the corporate sector has been in very good shape through this year.
You mentioned equity markets doing very well. Against that backdrop, government bonds were pretty muted really. What was going on there? Yes,
well, safe haven government bonds, by that I mean countries like the US, the UK, Germany, Japan, Australia, countries where you know you're going to get your money back, they basically returned the coupon plus a little bit. So fairly flat through the year, a couple of percent or so return, a little bit better than cash, but essentially government bonds, as we said at the beginning of this year, very expensive. Yields are very, very low, driven low to a large extent by actions of central banks, and I'll come back to that because that's been a key factor for 2012 returns. Central banks, in terms of quantitative easing, buying up government bonds and keeping short-term interest rates very low. But real yields are exceptionally low, the lowest they've been pretty much in history, and we've basically seen those markets flat through the course of this year.
Sticking with yields, we seem to see a continued dislocation perhaps between what we're seeing in yield terms and economic conditions. Let's have a quick summary of what's going on economically.
Yeah, look, I think it was probably a slightly disappointing year for economic growth, and it certainly wasn't growth in economies that drove markets through the course of the year. Without a shadow of doubt, the key thing that drove markets was central bank action. And all the major central banks in the developed world have been engaged in huge bouts of quantitative easing and keeping interest rates extremely low. So 2012, to me, really was the year that central banks and central bank policy drove markets. It's unusual to say that, but it was that rather than economic activity which disappointed on the whole, with Europe going back into recession, Japan stagnant, US a bit sluggish. Emerging markets certainly slowing down. China had quite a notable slowdown. So overall, economic growth disappointed. It was central bank action that was absolutely fundamental to the returns of markets. And of course, without a shadow of doubt, the key turning point in markets was Mario Draghi's, Draghi being the president of the ECB, his now famous speech in London in July, where he said the European Central Bank will do whatever it takes to preserve the euro. And you can chart the performance of markets from then, much stronger performance from that moment.
Against this backdrop then, the corporate sector having a reasonable year, any highlights in that we should take away? Yeah,
the corporate sector had a good year. Earnings were not as good as people anticipated at the beginning of the year. There's certainly been some slowdown in earnings, on balance of slightly disappointed, and what has driven markets really is a re-rating of markets to some degree. So there's been some disappointment on earnings. You've seen very good returns still from the sort of cash generative companies. Those companies paying good dividends have performed well in this period. Lots of volatility, of course, in the corporate sector, but on the whole, the corporate sector has remained very strong financially. Balance sheets in very good health. And although earnings have slightly disappointed, the fact is we have still seen reasonable earnings growth over the course of the past 12 months, and we've got the prospect of that, I think, in the next 12 months ahead.
Let's stick with the prospects for the next 12 months then. What's the sort of main themes you see for next year? What would our base case be?
Well, I would say that going into 2012 there were some very big tail risks that worried markets. The big one, of course, was the possible breakup of the euro. Most people, late 2011, early 2012, would have put a very high probability on Greece exiting the euro, and that, of course, could have resulted in literally a sort of pack of cards effect on the eurozone. So a big tail risk there. Of course, it didn't happen. One of the best returns from the year have come from Greek government bonds. Yields have gone from over 30% to about 12% today. Very good returns from peripheral European government bonds. Significant progress has been made in Europe. Greece, interestingly, I think the best example has run a trade surplus for the past 3 months. So there are signs that competitiveness is improving in peripheral Europe. As I say, yields have come down a long way, and there is no prospect in 2013 of the eurozone breaking up, whereas that was a real risk at the beginning of 2012. So that tail risk has been reduced substantially. I think the other important thing is China. China went through a significant slowdown from sort of 8 to 10% growth rates down towards 6-7% by the middle of the year. New leadership now in place in China. It looks as if there'll be some stimulus to the economy. This process of rebalancing the Chinese economy away from investment spending, infrastructure spending towards more consumption, that's a multi-year process, will continue. But it looks as if Chinese growth is stabilizing around the 7.5% area, so that's quite a positive. And then the US, I suppose that remains one of the more material risks because of the fiscal cliff, where negotiations are going on literally as we speak. The politicians have got to sort out this problem of tax increases and spending cuts, which would automatically take place at the beginning of next year unless they can come to an agreement. We've always felt they will come to an agreement. It's a little bit nervous at the moment, but it's looking as if there will be some compromise between the Republicans and the Democrats. They'll sort out the fiscal cliff. It will, however, result in some quite serious tightening of fiscal policy in the US, which could impact growth by around 1 to 1.5%. So that's an important factor for next year. And next year, we think, is another year in this long process of deleveraging that we've talked about so much post the global financial crisis. So growth being pretty sluggish. We're looking at growth rates of between 0.5% and 2% in the developed world, depending on which country. And I think that we've got a multi-year process still, but we are, remember, 4 or 5 years through that process now. So I think as we get through into the second half of next year, the impact of fiscal austerity, it will continue, but the year-on-year pace of change will begin to decline. So I think as we get into the second half of next year, we could begin to see growth beginning to pick up a little bit.
Glenn, against that backdrop of difficult fiscal conditions and only moderate economic growth, what bodes for the corporate sector?
Yeah, I think it'll be another reasonable year for the corporate sector. I think that looking ahead, we've got sluggish growth, but growth beginning to pick up as the year goes on. The year-on-year comparison is getting a little bit better. We've definitely got, without a shadow of a doubt, central banks remaining on very loose monetary policy. The Fed, the Bank of England, the ECB, the Bank of Japan, and the Bank of Japan even more so now we've had a change of government in Japan, are going to be engaged in quantitative easing. They're going to be engaged in keeping interest rates very low, and we can look forward to that certainly through next year and quite probably through 2014 as well. So I think a combination of loose, very loose monetary policy, tight fiscal policy, but the pace of change beginning to improve a little bit, I think is actually positive for risk assets. You could argue that valuations are not quite as good today as they were at the beginning of the year. That is certainly the case because equities are up 15-16%, earnings up by a little bit less than that. But equities in absolute terms still look good value to us. PEs are typically around 12, 13, 14 times. Good value, extremely cheap relative to safe haven government bonds, as cheap as they've ever been. So I think it's another year where equities will do materially better than safe haven government bonds. And probably this year, 2013, will do materially better than credit. Credit has performed extremely well. High yield actually outperformed developed market equities in 2012, but we've really had the big spread compression there. The difference in yields between high yield bonds and investment grade bonds and government bonds is now actually quite narrow. So I think now they're much more of an income play. Still okay, but more of an income play than expecting further compression in those spreads. But I think overall, I would anticipate quite a reasonable year for risk assets in 2013. Equities probably doing not quite as well as in 2012, but I could certainly see high single-digit or low double-digit returns from equities, and that would be very much better than safe haven government bonds, which I think could actually produce negative returns in 2013. So we're positioning our portfolios for another reasonable year in risk assets, somewhat overweight equities. We accept there are risks out there. There are quite obvious risks with the US fiscal cliff, the European situation, although it's a lot better, you could still get problems there. The emerging markets, we've seen quite a slowdown. Is that going to turn? Remains a bit of a risk. And of course, there are the geopolitical risks, particularly in the Middle East. So we're in a world that is not without risks, and we know this long process of deleveraging is going to run for some time and creates a tough economic environment. But overall, I think this multi-year period of equities actually performing reasonably well is going to continue through 2013.
So looking ahead to next year, reasonable economic conditions, but with tail risks still clearly. Central bank-led policy, and a re-emphasis of equities perhaps as the real growth asset class as opposed to credit.
Yes, I think we're going to see some of that. I'm not suggesting we'll have a massive year for equities. I think that's extremely unlikely because we are in this sluggish growth environment. But progress is being made. Post the Lehman disaster and the global financial crisis, progress is definitely being made. So we're on the right tack. I think there's been lots of debate about whether austerity in the developed world is a good or bad thing. I think it's beginning to show the signs of it's beginning to work. We know it's a multi-year process, so it's going to remain pretty tough. But the corporate sector remains in very, very good shape, and I think we'll do well next year. And I think equities will probably be the best performing asset class next year.
Thanks, Glenn.